Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined the show for the very first time, a huge welcome from us. We have a massive episode today. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
Bryce, I am very good. I'm very excited for today's episode. I am always excited. That's one thing you know about me. But you're excited as well.
Am I?
Because your favourite asset class has hit an all-time high.
Why is it my favourite? Bitcoin?
Oh, no, the price of cigarettes. No, Bitcoin has hit an all-time high.
It has hit an all-time high. It touched all-time highs. Back down a bit. But we'll get to that.
Yeah, we will get to that. We'll also cover all the other news of the day. And then we are back with another episode of Pimp My Portfolio, where a community member submits a portfolio to be reviewed by an expert. And then we're going to talk about market falls and share some research we've been doing.
Love that. Always researching here at Equity Mates. Let's get into it.
News and markets.
To kick off today, we're going to cover Bitcoin, the latest news from Catapult earnings. OpenAI is getting into hardware, and then a what the? Ren, let's start with Bitcoin. It's hit all-time highs. 109,800 is where it landed at the time of recording. I think intraday it got to 109,900.
Oh, so it hasn't crossed 110. This is all US dollar figures.
All US dollar, yes, USD.
But nonetheless, it's hit all-time highs.
It has. It's back. It marks the second time this year that Bitcoin has set a new record. It's up 47% from the April low of 75,000 USD.
Yeah, that was crazy, wasn't it? Yeah. It fell so quickly and it's risen again so sharply. No one can kill this asset class.
No one can kill it.
No one knows where it's going to go, but the calls of it being not real have quietened.
Yeah, it's really sticking around. To your point, Ren, no one knows where it's going to go. The range of outcomes from analysts for 2025 is quite large. 120K as a peak is on the low side. The bullish of bulls, 320K is their price target.
Yeah, but the bullish of bulls in Bitcoin are always over-exaggerating.
Of course.
Like, to be fair, like they've been directionally right so far.
Yeah. Best performing asset class of the last decade. Yeah. Easily.
Anyway, let's not talk about Bitcoin too much, but just it is worth marking the occasion that it has once again hit an all-time high. Let's talk about Catapult, because this is a company that I am super excited about. Full disclosure, I am a shareholder. I'm not sure if you are.
No, I'm not.
Okay, well,
what is it for
you
those
must be kicking yourself.
I don't swing at everything like you, Ren.
I don't swing at everything. I am very reserved. Look, put it this way. The ratio of companies I hear about and read about compared to the number of companies I invest in, still quite low.
All right, for those that have just joined Equity Mates, Catapult is a sports wearables company and data analytics company. They provide all of the devices that professional sports players use to track their performance during training, during live sports.
Think about if you've ever watched sport and you've seen a trainer reach into the back of a player's jersey and either pulse a device out or put one in, that's a Catapult device. Similarly, if you've ever seen players train and they wear it's like a little bralette that has a whole bunch of tracking devices in there that coaches and managers can then review how players performed, how much they ran, and then if there's any injury concerns or anything of the like. So it is the dominant player in the sports analytics and data space. It's not the only player, we should be clear. There are competitors. But how's this for a number? The number of professional sporting teams signed up to Catapult grew 9% year over year to 3,600 professional sports teams.
Globally. That's huge.
So the question that I had is, well, how many professional sports teams are there?
Professional?
Yeah.
I mean, tens of thousands.
Well, I asked ChatGPT.
Okay.
So if we just start with football, it sourced it, which was nice. The professional 4,400 professional football teams, soccer teams.
Wow.
Yeah.
It's a lot.
And then it gave me the US, and so I asked it to add up all the professional sports teams in the US. It gave me 706.
That feels very low.
Does it?
Yeah. Like, where do you, like, professional... There's professional badminton players.
No,
no. Why not?
Because they're not earning a professional. I feel like the distinction between amateur, semi-professional, and professional is how much you get paid.
Isn't it just that you can make money from it?
No, I think semi-professional
it's your job.
Semi-professional is you get paid, but you still have to have another job.
Like AFL umpires are semi-professional.
I guess so.
Yeah. It just feels low. It just feels low. Anyway,
let's not argue about it because neither of us know the answer. But by Bryce's reckoning, they still have a lot of growth runway ahead then.
Yeah, we were fortunate enough to speak with the CEO, Will Lopes, and that is the story. What is the penetration that they can get to? What are the additional services that they can provide? But the numbers are good.
Well, for me, that's only part of the story. So let's talk about the numbers. So year on year, 19% increase in revenue. Annual contract value, like the total value of all of their contracts was up 18%. But here is the other, actually, to close out the numbers, still not profitable.
No.
So last year they lost $19 million US. This year they lost $9 million US. So an improvement, they're getting there. But here's the other part of the story for me. So one part is how many teams can they sign up? But the other part is, so if I was to, you know the answer to this, but just pretend you didn't for the sake of this exercise.
Okay.
If you were the administrator of the Essendon Bombers, your favoured team, and you said, I am paying for data analytics and the software and tracking devices for all my players, all my professional players across AFL, AFLW, VFL, probably almost 100 players across those three lists. What do you think you'd be paying a year?
Hundreds of thousands of dollars.
That is exactly what I wanted you to say.
If not millions.
Because the average contract value among the 3,600 professional teams, just those, because they also have about 1,000 non-professional contracts, but across the professional sporting teams, the average contract increased 12% year on year, not bad, but to US $26,800.
Crazy, isn't it? Feels like such good value for money.
Yeah, well, and Will Lopes in announcing this result actually called it out. He said 20 years ago, the Boston Celtics, the NBA team who are a customer, was sold for $250 million US. And then earlier this year, they were sold for $6.1 billion.
Yeah.
So the money in professional sports is just getting crazy. We know that. We know how much payer payments are increasing. And so for me, it's like, what pricing power do Catapult have over time to increase prices, to correctly monitor these increasingly valuable assets, which are their players? So anyway, I'm not here to pitch the stock.
No, it's pretty compelling. It's reminding me of a conversation we had with James Abella from Fidelity, where he was talking about the stages you can go through and the sort of the re-ratings that companies get. And one is from like very like non-profitable to, almost profitable, from almost profitable to slightly profitable, and then slightly profitable to very profitable. And this is certainly the direction that Catapult is going.
It is. Yeah. And like, it's been a basket case in years gone by. Like, it has been a mess of a company. On some metrics, it looks quite expensive. So like, you've got to take the good with the bad, I guess, in this segment. But it's a company that gets me excited.
Yeah. Well, Rand, let's keep moving. OpenAI is OpenAI is getting into hardware.
That's right. ChatGPT coming to a handset near you, maybe a headset, who knows? But the story is OpenAI is acquiring I.O., a company that was co-founded by former Apple design chief Jony Ive, who like iPod, iPhone, like some pretty big hits in his repertoire. OpenAI are buying the company for $6.5 billion US in all stock. So all OpenAI stock. And the idea is to develop a family of AI-powered devices. We're talking hardware here. The purchase adds about 55 hardware engineers, software developers, and manufacturing experts to the OpenAI team. They're going to create a dedicated hardware within OpenAI. No indication of what they're going to build first, but it's a pretty big step to go from software to hardware.
It is.
A lot of big tech companies have failed at that step.
Yeah.
Do you remember the Microsoft Zune?
Yes.
Do you remember the Amazon phone?
Yes.
Do you remember the Meta phone?
Yes. Even Meta glasses.
Yeah, well, I haven't failed yet. Google glasses.
Google glasses.
Yeah. There is a long history of tech.
Apple car that they spent almost 10 years and billions of dollars on. Never got off the ground. Literally.
True.
Apple TV. An actual TV.
Okay. I feel like Apple has some
hardware.
runs on the hardware board.
True.
But like there is a long history of non-hardware companies trying to get into hardware and not doing too well at it.
Yes.
So this will be an interesting one to watch. But if you were going to get into hardware, you could do worse than getting the former design guru from Apple.
Well, we're going to close with a What The, which is a segment in our daily newsletter where we bring to light a news story that is somewhat entertaining, a little bit interesting, piques our interest, that falls outside, I guess, the more traditional business headlines that we're summarizing for you that we think are important and move markets.
Yeah.
And today's What The is around the enhanced games.
Yes, and we promise there is a business angle to this. Enhanced games is basically the Olympic Games where doping is allowed.
Yeah. Let's see what's capable.
Anything that can improve human performance is allowed.
Go for it.
Remember those swimming suits?
Back on the table.
They're back on the table. Doping.
Runners, the marathon.
Oh, true. Yeah. Back on the table. Just like what is the peak of human...
Motors on push bikes?
Not allowed.
Back on the table.
So the news is that the date and time for the enhanced games have been announced. Maybe unsurprisingly, it's happening in Vegas next year, 21st to the 24th of May.
Maybe Equity Mates tour to the enhanced games.
I would honestly be interested in checking it out. I don't know where I stand on it from a do I support this or do I not support it point of view.
I'm pretty interested to see it.
I'm certainly interested. Yeah. James Magnussen, the Australian swimmer, former 100-meter swimmer, has become the poster boy for the games. He's got a $1 million challenge to break the 50-meter world record.
Yep.
And if he does it, he gets the money.
Yep.
He'll be doing it at the games next year. But his swimming weight was 95 kilos. Apparently, he's hitting the scales at 115 kilos.
Unbelievable. Now. Do yourself a favour. Google it while you're listening. The Sydney Morning Herald has a good swiping image where it shows you the comparison and... It's huge.
Yeah, he's jacked.
He's been juicing.
So there's a business angle here. The big backers of it, Peter Thiel and Donald Trump Jr.
Yeah.
Which I find interesting. Yeah. It's like, what's the investment return on an Olympic game style event?
I mean, people are just
big.
I think it's going to appeal to a particular I think it's going to appeal to a particular subset of society.
Yeah, I mean, if you have
there'll be a lot of betting on it.
Yeah. If you have sprinters running like a 9-second flat.
Weightlifters.
The really interesting thing for me is I reckon the first iteration of it will be a real juxtaposition of peak human physicality versus enhancement. And what I mean by that is like if you have a shot of making the Olympics, you're not going to be going for the enhanced games now. No. So it'll be like the fittest people in the world in their peak athletics moment, like late 20s or whatever it is, being put side by side with people who are probably a bit past it, maybe were almost in the Olympics or were Olympians like James Magnussen, but have passed their physical prime, but are then getting juiced.
Unless it becomes like a live golf equivalent where it's not just James Magnussen who's getting $1 million. It's like every sport top prize and you're just like, stuff it. I'm not, winning a gold medal in normal Olympics gets me sweet FA. I'm going to go for the $2 million prize for the fastest enhanced 50 meters.
True. The one distinction is if you signed up with Live, you could always go back to the PGA.
True.
As soon as you go enhanced, the Olympics aren't going to take you back.
You're done.
But it is fair. It's like, what if the Saudis dump a boatload of money into the enhanced games?
And it's 20, One to watch. Make sure you subscribe to our daily newsletter so you don't miss more of the what-thers and, of course, all of the business headlines that we summarise straight to your inbox 6 a.m. every day. Welcome back to Equity Mates. It is time for...
Pimp my portfolio. Pimp my portfolio.
That's right. This segment is all about improving the portfolios of the Equity Mates community members, and we have an expert in the studio today to review the portfolio of one of our members. And on the line, we have Brandon. Brandon, how are you?
I'm good, thanks, Bryce. Thanks for the time, guys.
Anytime. Thank you for submitting. And Matt, welcome.
Yeah, thank you. Nice to be here.
So we've got the portfolio ready to rock. Ren, do you want to take us through it?
Yeah, let's do it. So I reckon Brandon runs a bit of a core and satellite approach here, looking at the portfolio. Starting with the ETFs, we've got about 80% of the portfolio across 6 ETFs. We've got VGS, Vanguard International Shares. We've got VAS, Vanguard Australian Shares. We've got 2 US. We've got 3 US, VTS, Vanguard US Total Market, iShares, S&P 500, Beta Shares, NASDAQ 100, and then rounding it all out, we've got VDHG. Then we've got 5 individual stocks, Drone Shield, EM Vision, Guzmini Gomez, ResMed, and Shine Justice. And then closing it out, we've got some Bitcoin and Ethereum.
Love it. Alrighty. Well, Matt, before we hear from Brandon, do you have a nickname?
Yeah, so as soon as I saw GYG in this, I thought, this is Nacho Average Portfolio. That's a shocker.
That's well done.
I've got a better. Well, I changed my mind on it though. Okay. When I looked closer, I thought I'd call this one Taco Bout No Diversification.
Okay.
My apologies.
That's the quality of pun that you can expect, Brandon. But before we get Matt to unpack what he's talking about there with his 2 nicknames, tell us a bit about how this portfolio came to be.
Yeah, definitely. So you're spot on, Ren, about the core and the satellite approach. That's certainly the way that I've gone about it. It started off, I guess, with your stock standard. I started with VAS and then went into VGS to sort of go a little bit more global. I know that there's obviously a bit of overlap there, having, obviously the VDHG there as well. Really the only change since I submitted this was that I've sold the VTS, but all the others have stayed there. So I know that, there's a bit of sort of overlap there, and I think that's something that I've always sort of struggled about, do I do the all-in-one or do I sort of split it up myself? Other than that, it's certainly a long-term focus, trying to sort of hold these ETFs in particular for just a long period of time. I've been DCAing into them, regular amounts, primarily into VAS and VGS, maybe a little bit into IVV. Looking at it from a long-term perspective, ideally just trying to build up these ETFs so you don't have to worry too much, but then also just having a little bit of a play around with some of these individual stocks, ones that I've either got some sort of level of knowledge or interest or whatever the case may be that, leads me to put a little bit into it. And that just, makes it a little bit more, I guess, exciting as well, just to sort of watch these individual stocks go as well. And then just the crypto has just been, I haven't bought any crypto for a long time. That's just sort of originally what I had, and sort of just keeping it there just in case there's ever a sort of another massive run on Bitcoin or something that can make the needle move a little.
Oh, there will be. Don't worry. I'm hoping you didn't sell VTS over the last couple of days when at time of recording, when we've seen the market absolutely fall from the bottom. But Matt,
no, it was a couple of months ago.
Nice,
so, yeah.
nice.
Nice, you timed it very well.
Well played. So, Matt, what are your thoughts?
Yeah, look, so Brandon, you're obviously really aware of the overlap, and that's always the biggest feedback with ETF portfolios is there's always a bit of overlap. I like your thinking with VGS in trying to get some more international exposure there, but even VGS is about 80% US. So it is just another big US fund, really. Going back to the name, talk about no diversification. There's obviously diversification in here, right? You have a bunch of ETFs and there's plenty of companies throughout that, but it probably just comes back to it's an illusion of diversification. It looks like there's more than there is because there's a few names in there, but they're all doing more or less the same thing. But you're aware of that, so I won't labor that point. Just to expand out of that a bit, I like ex-US ETFs for that international exposure because it lets you have some flexibility on how much you're allocating towards the US and how much you're allocating elsewhere. So when you look through these ETFs, you're about 56% US shares. Other countries, you have about 9%. Not including Australia. So, Europe and Asia and other places, only about 9%. So something like VEU would round that out quite well. VTS is probably the one that I would have sold as well, and just focus on a bit of a tighter core there with IVV and NDQ. So I think you've done pretty well there.
So Matt, just specifically then, we've got IVV, NDQ, VGS and VDHG all giving relatively strong exposure to the US. If you personally were to consolidate and just choose your core US exposure, what would you be doing?
If it was just core US, then it would be probably IVV.
Yeah.
Unless you wanted to take a bit more of an aggressive approach, then NDQ makes sense. So having both of those in there is fine. VDHG has a few other bits and pieces mixed in there. It's got a little bit of fixed interest, which is a good thing as well. It's a good one-stop shop, obviously. So if you didn't want to think about rebalancing and this and that, VDHG would be the one to go. But if you want to just keep a US core, IVV and NDQ, I think is the way to go.
Yeah, nice.
Matt, let's turn to the stocks. So Drone Shield, EM Vision, Guzman, ResMed, Shine Justice, all Aussie. So where do you want to start?
Let's go with ResMed. ResMed is one that I really like, and a lot of people really like it. It's a Aussie success story, and a lot of their competitors have had a bit of a rough run in recent times with callbacks and supply issues throughout COVID and beyond. So yeah, we like ResMed. There's been those concerns about GLP-1 drugs, but that seems to be turning a little bit to this idea that might actually be good for things like ResMed. I'm not particularly old and I'm fairly healthy, and I've been told I have mild sleep apnea. I should sleep with a ResMed device,
really?
Right? So it can affect anyone, really. Yeah. I'm yet to do it, but all I'm saying is it really can affect it. The market for ResMed products
chronically
is huge.
undiagnosed.
Yeah. As a ResMed shareholder, I think you should go and get a sleep test.
Well, that's actually one of the reasons that I looked into it as well, as I'm actually in the same boat. I've got the diagnosis, don't have a CPAP machine or anything like that, but knowing that there's obviously such a market out there for it, I thought that it was a pretty good company, even with the introduction of the GLP-1s.
Invest in what you know.
There's some estimates that like 90% of people with sleep apnea are undiagnosed.
Yeah,
it's just
and I mean I've got a colleague that uses one, and he doesn't like need it. But he says he feels amazing when he wakes up because he uses it. And
so ResMed need to do a better marketing job of convincing people that it's not. You're going to feel amazing. Yeah. That's where they should be playing.
So ResMed I think is just a good long-term hold. It's a pretty tiny allocation in your portfolio at the moment, but that's okay. Just hang in there with that. GYG came out with a pretty good result earlier this week. Yeah, so they are doing well. If you are into the Mexican food market, then we also like Chipotle. Chipotle run a bit of a different model to GYG. So GYG franchise most of their stores. Chipotle have direct ownership, so a bit more control over quality and operations in that sense. Typically, a franchise model is more profitable, but Chipotle kind of buck the trend there. They have a 26% operating margin versus about 16% for GYG. So they're, really strong business, expanding rapidly. So GYG is good, but we also like Chipotle. Shine Justice, I don't know, Ren, you have a pretty good history of investing in legal stocks, so maybe you could talk to this one.
I wouldn't touch it after my experience with Slater and Gordon, but I don't know anything about Shine Justice.
Neither do I. That's why I pumped it off.
What's the story there, Brandon?
I'm a solicitor for Shine, so I just wanted to have a little bit of
skin in the game.
A little bit.
That makes sense.
Exactly right. Just a little part of what I'm working for. I know obviously it's quite a small allocation, but just thought I'd have a little piece of it.
Nice. Well, Matt, I have a question. You mentioned there just some of it. So about 80% of the portfolio is in sort of core index, and then we've got 6% in individual stocks and then about 13% in crypto. How do you think about the weightings of core and satellite here?
Obviously, some of these satellite holdings, you're just taking a bit of a punt, really. At a 1% holding, if all else stayed equal or stayed the same, Drone Shield would have to double to add another % to your portfolio. So these things have to really move to actually move the overall needle. So that's fine if it's more of just a little side thing that you like doing. Typically with a core and satellite, we would reduce the size of the core a little bit, but that's only if you want to pay more attention to the satellites. So if you're not willing to do that, just keep going hard on the core, and probably just diversify that core a little bit more. It's 56% US shares at the moment when you look through, only about 9% in other countries. So just trying to broaden that out a little bit to diversify. And yeah, I mean, look, with the crypto, that's a pretty hefty allocation to crypto as well. If you've got the stomach for it, then by all means keep it there. But you mentioned you're not buying anymore. So if you just want to see how it goes, then that's fine.
Yeah.
It's hard to reduce your crypto exposure if you've been in for a while and it's run. That's for sure.
Yeah, definitely. Yeah.
You always see the possibility of it just going crazy again and the feel of potentially missing out on it. So, I think it might just be a sort of set and forget and just leave it what it is. But certainly the plan would be, as I said, not to add to it anymore and just increase the rest of the portfolio so that overall percentage just sort of slowly goes down.
Yeah.
We talk about cognitive biases when it comes to investing, and I reckon Bryce just exhibited about 3 of them. Endowment effect, falling in love with things you own, FOMO, fear of missing out. There's probably a few more in there as well.
I'm not FOMO Bitcoin. I'm saying like I understand why it's such a large position.
Yeah. Well, Brandon, I think there's a lot to like. I think that's the key takeaway. Think about the overlap in some of those ETFs, but the thing is, you're already thinking about it.
Yeah.
Be careful of law firms as investments, but that's just my personal experience. But yeah, no, well done and keep it up.
Did you have any final questions for Matt?
Look, I think the main one was about the I guess the overlap and that sort of constant reviewing of the portfolio to make sure that there's not too much of a concentration in areas, and obviously that ongoing question of do I pick the individual ETFs that are geographically located, or do you do an all-in-one VDHG? I think I like being able to sort of if I want to put more in VAS, I can.
Yeah.
So that way sort of I can pick the weightings a little bit more. But having said that, the VDHG, we're thinking about, just sort of allocating that to my son basically, and that's an all-in-one. That can be his one for the future sort of thing, and that way we don't really have to look at it. So trying to use sort of the pros and cons of all of them to suit us the best.
Yeah, there's diversified funds like VDHG or DHHF. They're great for basically what you just mentioned. If you're doing this for your child, or if you just purely don't want to think about it, if you don't keep up with what's happening in markets, that's great. If you're somewhere in between being an active stock picker and wanting a one-stop shop, then having those geographical ETFs where you can tweak them makes a lot of sense. And it sounds like that's probably where you fit in, Brandon.
Yeah, I think so.
Love it. Well, Brandon, thank you so much. Matt, thank you very much.
Thank you.
And Brandon, we really appreciate you submitting, and good luck with it. And of course, thanks for all the support listening to the show. We do appreciate it.
No worries at all, guys. Thanks very much for the opportunity, and thanks for all the content you guys put out. It's been a massive part of my investing journey and education, and to make it exciting, but also, just to know what's going on. So I know that I'm not alone in the community. So yeah, thanks very much for all the work you guys do.
We appreciate that. Thank you, Brandon.
Yeah, thanks, Brandon. That's nice to say.
All right, thanks for your time. Cheers.
Panicking about the market fall? Don't. Market falls are a normal part of investing. If you don't believe us, we have 75 years of data to prove it. So Ren, take us through it.
Yes, markets fall, that's normal. That is the headline. That's what we want to convince you of. We've got data out of the US to prove it. Because market falls are on our mind recently. Post-Liberation Day, the market fell sharply. In Australia, it was down about 8% in a week. In the US, it was down double digits in a bit over a week. But then it's recovered. So we had a look at some data out of the US, looking at the S&P 500 to look at their returns, but also market falls within years.
Okay.
So let me start with the headlines. In the past 75 years, the average annual return of the S&P 500 is 11.6%.
Love that.
So this is total return with dividends reinvested, but 11.6%.
Solid.
So put it in a compound interest calculator just to remind ourselves of why we invest.
Yep.
$200 a week, $200 a fortnight invested at 11.6%. Now I couldn't do 75 years because they only let me do 50 years.
What?
$10 million.
Wow.
But okay, 50 years, unrealistic for... Actually, not that unrealistic.
Nah, start when you're 11, Buffett. You'd be cruising.
But let's say 35 years. That probably makes it more realistic. $200 a week.
3 mil.
2 mil.
2.
Still.
Not
pretty
bad.
good.
Yeah.
So that's the investment returns. That's the opportunity. That's why we invest, because the stock market has been this consistent wealth builder that's outpaced inflation, that's outpaced any other asset class over the long term. But the thing is, the market falls. It falls regularly, it falls often, and it can fall sharply. In those 75 years, if you look at the how much the market falls into year, so like the biggest fall each year, the average inter-year fall is minus 13.6%. So a double-digit fall is completely normal. Now, if we just zoom in on the last 10 years, so make the timeline a bit narrower. Over the past 10 years, we've had some good years and we've had some shocking years. The best year, do you want to guess what it was?
The best year?
Yeah. In America in the past 10 years.
2024.
2024 was good. We returned 25%. But the best year was actually 2019, 31.5%.
Strong.
So over the 10 years, the average annual return of the S&P 500, 14.26%.
Wow.
But the average inter-year fall, minus 13.56%.
Wow, there you go.
Yeah.
I mean, we're literally living through this right now.
Yeah.
The S&P fell from its peak in mid-Feb. Liberation Day came in April, and I think over that period it fell almost 20%,
Yeah.
I'm going to say, 19% or thereabouts. Yeah. But the market's flat.
For the year.
Yeah. So, I mean, this is playing out right in front of us.
Yeah.
It's a great reminder that these swings and troughs, it's just something if you've just started investing, you've got to become used to it.
Yeah, and I think the important thing to stress and like the point why we're saying markets fall, that's normal, is we might think that this is an abnormal year. The biggest inter-year fall, the biggest drawdown in the year being 20%. And if the market ends up returning, 5% or 8% or whatever,
forgotten about it.
That is like a bang average year.
Yeah.
That's just what happens.
Yeah.
And like some years, obviously the market doesn't rise every year. Some years the market will fall, like 2022, the biggest inter-year fall was 25%, but over the year the market was down 18%. So there are years when the market falls, but the interesting thing is, I'm just looking at the 75 years worth of data. There isn't one year where the market hasn't fallen at some point.
Yeah, that's good. And I think then that goes on to show why a dollar cost average strategy is one that really works during these periods because, last 10 years, 2015, you probably would have been buying as the market fell 12%. 2016, you would have been buying as it fell 10%. And the story goes. So as the market's falling, you're able to pick up more and more of the market. Mm-hmm. And then lo and behold, it finishes the year in positive territory and you've been investing the whole way through.
Yeah.
Can't complain.
There are some crazy good years in here. How about this? 1954. The biggest drawdown in the year, throughout the year, minus 4.4%. The market returned 52.6%.
Wow.
That's a year you would have wanted to be investing in.
Wow.
Yeah.
Well, I remember 2019.
You remember 1954?
Yeah, I remember 2019, 2021. We'd just started doing the podcast sort of a few years in and that we kept being like, what is going on? 31%, 18%, 28%.
It was a good time to invest. But here's the thing, 75 years of history shows us that there's been plenty of good times to invest.
Absolutely.
And that is why you need to stay invested, stay the course. If you haven't started, get started. You never know when the good days will come. You never know when the bad days will come. What you do know is that markets will fall at some point every year over the journey. Sometimes those falls will be pretty big, but keep in mind there's never been a dip that wasn't worth buying.
Yes, that's it. Well, that brings us to the end of today's episode. If you're a financial advisor, we do have a separate channel that we've just launched. It's called Basis Points, specifically designed to help you find the small improvements that compound into big outcomes. Of course, it is free and available to anyone listening today. So, of course, go over and have a listen. But we do recommend that if you're an advisor, you go and subscribe to that channel. It has an email attached to it as well. Every month, we'll send you insights from the Equity Mates community to help you get ahead of the next generation of wealth clients. We'll put a link in the show notes to sign up and to subscribe. But Ren, that does bring us to the end of today's episode. Always great to chat stocks. Thank you for listening. Subscribe wherever you're tuning in, and we'll be back next episode.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.